Like we talked about acquisitions, we're going to go through the acquisitions first. And one of the things under acquisitions is what are your funding options, right? And so you can obviously get a hard money loan as an investor. And there's actually opportunities right now that I've actually employed in this high interest rate environment. There are hard money lenders that are doing 100% financing. Now, typically, they are usually doing this for experienced investors. So if you've already done some rehabs, I think some of them might have a requirement where you have at least 2 to 3 rehabs under your belt, are basically in the right manner based on the 70% of ARV, including your repair costs. As long as those numbers look good and you've got experience, you can technically get a hard money loan for 100% of the funding. Now, what I've done in a recent deal is I've also included a private money loan, even though I'm getting 90 to 100% financing from the hard money lender. I'm getting a private money loan to do my carrying cost, your rehab. So even though your hard money loan is giving you 100%, they're not going to fund your rehab portion of the project until you are completed with each section, right? So you get your flooring done, you get all your interior paint done. You've got to be able to front and pay your contractors to get that work started before you can do a draw request from the lender. So even though they're financing technically all of your rehab expenses in most cases on your rehab project, you're going to need cash available. In a lot of cases, that cash could be 10 to 15 to $20,000. Your contractor needs money to get a deposit to get the materials to get started on the project, usually 10 to 12% interest right out of the gate. So you've got to pay that each month. You've got to do your float for the rehab costs, like we've talked about. You're also, as you get the rehab project done, you're going to need money for staging the property, right? And so you can get your private money lender involved, and usually around the same 8 to 10% interest cost, your private money lender can cover those expenses for you. You can also waive the carrot if this is going to be a short-term rental and you're going to be generating short-term rental revenue, that you can give the private money lender like a preferred return plus a profit share as a part of the deal. But what it does, you're now basically offloading the financial expense of doing an acquisition on these different partners. Now, obviously, all this costs money. There's a return that these lenders are expecting. And so you always look at a rehab project where you've got a lender as a partner. Your contractor is going to be your other partner because you're getting a big chunk of the money that's involved in the deal. And then you're the third partner, right? You can structure those transactions such that you're going to be managing the project and overseeing everything, and you're able to take your part of the deal as a result of that. That's just one example. You can also purchase these based on a DSCR loan. And so a lot of these same lenders will provide a DSCR loan that gives you the ability to qualify for that purchase price based on how much money that short-term rental is going to generate in revenue. And so this is looking at the debt service compared to your monthly expenses versus looking at your income or your FICO score as a qualifier. There are also lenders that specialize in lending for short-term rental purchasing. And so we have various options of those types of lenders. Basically, historically, most lenders, when you go to refinance out of your hard money loan, historically, financial companies, banks, they are perfectly fine looking at long-term rents as projected revenue to give you financing to refinance your loan. Now, and we're going to talk about the refinance in a minute, but these short-term rental lenders will actually give you credit for 70% of the short-term rental revenue, right? So they're still giving you a haircut, but 70% of the short-term rental revenue is still going to be way more than what it would be as a long-term rental. So they're going to qualify your loan and your financing based on that short-term rental revenue or 70% of it, which gives you a pretty good spot to be in terms of being able to qualify. So you can either buy the property retail right out of the gate and be able to do it with a short-term rental lender, or you can do it with a DSCR loan instead of doing the hard money loan. So what that does is it gets you right away into a 30-year or 15-year loan, and you can be off to the races generating your short-term rental revenue. If you do the rehab, obviously, you're going to do that first 6 to 12 months as a hard money loan. But the whole objective here is to ultimately be able to refinance out of that into a longer term loan in your acquisition strategy. Now, the other option for acquisitions, and given the current environment as a real estate investor, seller financing or creative financing is a good way to basically acquire a property where you're not having to deal with a bank. You deal with the seller of the property. There are a lot of older folks that are retiring or downsizing or probate situations where you can set up a seller financing opportunity to buy the property and come up with some sort of a down payment in some cases, or not at all, depending on what you can negotiate. So you can still do seller financing. Another big thing, a lot of deals are out there right now that we are looking at and that some of our students are looking at are subject to loans, right? So the interest rates are still, even though we just had an interest rate deduct, interest rates are still in the 6-7% range. So you can pick up properties that are subject to the existing mortgage where you're looking at anywhere from 3 to 5% as an interest rate. You're still going to need probably a down payment to buy out their equity of anywhere from 30 to 50,000. But all of a sudden you're now in a property without dealing with a bank. You're going to take over their existing mortgage and their existing mortgage payments. And this is an attractive option because you are inheriting that lower monthly mortgage payment that's lower than what it would be if you were to get a brand new loan. And so it's definitely an attractive option for acquisitions. So once you've done this, whether you're doing hard money or subject to or seller financing, there's always the option later to refinance out of that loan. You can do 75 to 80% of ARV. So on your refinance, you can actually pull out cash. So let's say you do a rehab and you've basically finished the rehab, the property's fully up and running, fully remodeled, and now your ARV is, let's say you bought the property for 100 and you put 50,000 in it as a rehab. And just to keep the numbers easy, let's say your $200,000 is your ARV, right? So now you can do a refinance and you can do 80% of 200,000, which is 160. So now you can pay off your hard money loan, your private money lender, and you've got $10,000 or $15,000 in cash that you can pull out. You can use that cash towards staging the property or investing in another property. So that's another good way to continue to scale under acquisitions, is by doing a refinance at a lower interest rate. Now, hopefully the rates start to stabilize and come down to where that's a good option for you after you come out of your hard money loan. So those are all the ebbs and flows of the funding options within acquisitions. Now, I want to talk about some of the market advantages by doing acquisitions, okay? And what I mean by that. With the short-term rental model, as investors that are actually out there buying rehab projects, traditionally, a lot of times they stay away from two-bedroom houses as an example. But because what happens is, from a rehabber's perspective, when you're doing fix and flipping, your objective here is to do a retail sale. You want to fix up the property, buy it distressed, fix it up, and then sell it on the retail market. There's not many families that are buying their starter homes that are looking for two-bedroom houses. When you're looking at distressed and properties needing rehabbing, usually the two bedrooms get overlooked by investors. They're not as in high demand. If they do, as an investor, if you do look at a two-bedroom, you're typically going to want to add on a third bedroom. You're going to make it a larger property as a part of your rehab project. So what does this do? From, if you're looking to buy a property for a short-term rental, a two-bedroom becomes an attractive option. You've got less competition from other investors. and it's still a really good, profitable option with the short-term rental model. So that's one market advantage. The other one we touched on a little bit earlier, and we have quite a bit of investors that are taking advantage of what's called a house hack. And especially if you are single and you're not married, you don't have kids yet, or you're just starting out, or if you're the other side, if you're divorced and you've got flexibility in where your primary residence is or where you live, in acquisitions, the house hack is an interesting option. You don't have to be single to do it, right? But he and his wife did this strategically and ended up adding 10 properties to their portfolio by doing this once a year. So every year they would buy either a house that had a separate entrance basement or that could be made into a separate entrance basement, a duplex or a triplex, right? So a property that's got two separate dwellings within the same property. And so you basically buy the property usually as a distress needing fixing up. And so you're going to plan on living in one side. The other advantage of doing this is when you're buying the property as a primary resident, you can basically get a lot of the financing options for buying your primary residence that you can't get as an investor, which means lower down payments, sometimes better interest rates, things of that nature. And you're able to do this strategically. And if you happen to be in that bucket where you're flexible, that's a good way to get started. You may already have a property that is house hackable that you already currently living in that just needs a little bit of a conversion. And so all of a sudden now you're living in a property for free, right? Because you can generate revenue in the portion of the house that you are renting out as a short-term rental. And that monthly revenue basically can cover all of your expenses and then some. And like I mentioned, it's a good strategy to do with acquisitions because you've got that flexibility, especially if it's a property that you're able to live in at the same time. Another market advantage with acquisitions is what I call problem properties, right? So what's a problem property? So you've got, again, in the traditional retail real estate market, fix and flipper or somebody trying to sell a recently rehab property are usually selling to families that are either first-time home buyers or they're upsizing, they're buying their next home, and they want to stay away from busy streets, the backyard noise, or you've got like a major highway that butts up into the backyard. And so what you will see is those types of properties will sit on the market on the MLS for a much longer time than the average. And these are perfect opportunities to come in and pick up as a part of your acquisition strategy, because obviously as a short-term rental, it's a benefit to be on a busy street, right? If the average stay for your guests are 3 to 5 days, they're less concerned about, from a family perspective, their kids playing in the front yard. They don't really have the same needs and wants as a long-term retail buyer does. The busy streets is less of an issue. Same thing with the backyard noise. They're not going to be in the backyard. They're usually traveling. They're going out. They're not at the house that much. They will be outdoors hanging out, but the backyard noise is less of a concern. That creates a niche as a part of your acquisition strategy that you can look at those problem properties that have been on the market for a while. You can negotiate a lower offer and be able to get into those properties strategically for the purpose of short-term rentals. So one other example here is what I call basically hood houses. A lot of the fix and flips that are done are still done in areas of transition, properties that are still somewhat high crime areas or areas where there's a lot of abandoned houses that are boarded up, houses that have been burnt out, not rehabbed yet. You can still pick those up at a discount. You can still do the rehab, and you can definitely still be able to generate it as a short-term rental by doing the proper disclosure in your listing description. So that's another kind of niche that you can strategically look after. Now, I've had better use of that when it's become a fix and flipper that has not been able to sell their house because it is in the hood, right? And so you can step into that as an opportunity to manage the property for that investor that's not been able to sell it. So that's another angle with hood houses. All right. So the other thing I want to talk about with the acquisition strategy are the property types, right? Property types, you can basically buy a traditional home, right? So your standard 3 or 4 or 5 bedroom home, obviously it could be modern build, it could be just regular. So that's obviously a good option. You can also do ADUs, or accessory dwelling units, is another way to strategically do acquisitions, and you can actually do it on the back lot of a existing property to generate additional revenue. Same thing with tiny houses. You can do a tiny house build for as low as 50,000, as high as 150. There are what they call glamorous sheds nowadays, where you can basically put a shed in the backyard and kind of retrofit it as a tiny house. That can be much cheaper than 50,000, could be 25 to 30,000. Then obviously, if your goals and aspirations are more vacation-y, lake, mountain cabins, from an acquisition standpoint, you could go that route as an option. I've talked about the lake house that we've done that generates anywhere from $800 to $1,200 a night in rental revenue, obviously at a much higher price point than a typical rehab. But if that's strategically what you'd like to do, that's an option, right? You've also got luxury tents. Now, when I say luxury tents, people that haven't really seen these, they are really high-end, kind of safari style, fully equipped kitchens, fully equipped bathrooms, AC units, king-size beds. So they're all the proper amenities, but just happen to be in a luxury tent, usually somewhere near where there's some sort of an attraction, whether it's state park or lake or a mountain. Same thing with luxury tents, luxury tree houses, and you can generate 50 to $300 a night for someone who does projects. Some people that have land, that's a good option to look into. The glamping has become quite popular. You can also look at RVs, mobile homes, as an option. And then, of course, there's multifamily, right? So you can look at buying triplexes, quadplexes, smaller, mid-size, 10-unit, 20-unit multifamily buildings for acquisitions. So those are all great options to look at. Obviously, a lot of us fall into this category, traditional home, especially if you've already got experience acquiring and rehabbing and doing just regular types of properties. But there are also, later on, there's also other interesting options you can get into once you get started and once you get the experience under your belt. All right. So the other thing I want to touch on for the acquisition strategy is what's involved with the process. Now, remember, if you guys have any questions, feel free to throw them in the Q&A. So the process, basically, and a lot of you are familiar with this already, right? You have, obviously, you want to, once you've figured out your acquisition strategy based on all those different options, you want to be able to look at strategically prospecting for those types of properties. You want to be making offers, right? Now, as an investor, you can make offers contingent upon your due diligence period, right? And you can make it contingent upon getting financing. You can make it contingent upon your business partner reviewing, right? So as an investor and in your acquisition strategy, be very comfortable making offers as long as you've clearly defined your due diligence period, which gives you an out to be able to recoup your earnest money in the event you find something during the due diligence period or your contingencies are not met. So it allows you to back out of that deal without losing any earnest money, right? As an investor, once you've figured out strategically what type of properties you want to go after, you want to be out there making offers, right? You're not going to be able to have deals if you don't make the offer. Now, a big part of being comfortable making the offer is understanding your rehab budget, even if it's small, right? So even if the property doesn't need that much work, but it just needs interior paint or carpet or flooring, you need to have a good understanding of what that cost is, right? And so that piece is very important because it's obviously your ability to get financing, whether you're doing hard money lending or private money, is all going to be based on your decisioning on the rehab budget. Now, equally important is your calculation of the ARV. If you're using a lender, a lot of times you're going to need to get an appraisal. And so before you get to that part, though, you're basically, as you come out of the due diligence period, there's the inspection period. And which, by the way, when we work with our students, we help you and work with you every step of the way when you're making an offer. We're helping you with the market analysis, making sure you've got everything covered. We're giving you some pointers on what to negotiate for in your offer. Once you're in your due diligence period, we're actually helping you to confirm the rehab budget and making sure you do your inspection during that period. If there's any items that come up during that inspection, we help you come up with strategies on either negotiating terms or having a good understanding of what those things are. For example, if you've got water damage or water intrusion in the property, and that's identified in your inspection period, how do you handle that? How do you get a quote for that? If there is evidence of foundation issues, how do you get that checked? How do you reach out to an engineer to do that? So all those different nuances, we actually help you through that process. Now, when you get your financing done, obviously the ARV is as important, if not more important than the rehab budget, that you do that correctly. And so we can help you with that as well. And then, of course, as you get closer to your closing, you want to get your insurance in place. We've got a lot of different companies we work with that include short-term rental operations as a part of the process. And so, in a nutshell, that is the main walkthrough that you would need to do. And obviously, go to closing, get the property closed on, and then get your rehab process started and get it ready for as a short-term rental. Basically, the last and final thing on acquisitions, and then we'll jump into some questions here, is, and we've touched on this a little bit in the previous example, right? But you've got cash flow and equity now through the acquisitions process, right? A typical purchase, your monthly cash flow could be $1,500 to $4,500 plus. Obviously, you're going to have appreciation of the property each year that goes by. I can only spell, right? So you have that as your go forward, basically, ability from acquisition strategy. So 1,500 to 4,500. My net cash flow on my lake house, for example, was in the 15 to 16,000 range per month. But we also had a mortgage payment of 8,000, right? So it's all relative. But depending on the size of the property, obviously, and the purchase price, your typical rehab property in that $300,000 to $400,000 range as a purchase price is going to be in this range as far as your monthly net cash flow potential on an acquisition, if that makes sense. So that completes my deep dive on the acquisition strategy. Let's see if we have any questions. So what does DSCR stand for? DSCR stands for Debt Service Coverage Ratio. Basically, what they're doing there is measuring the available cash flow to pay the current debt obligations, and not really paying attention to what your personal income is or your business income is. It's going to look at the ability of that property to generate cash flow and to pay the current monthly loan. That DSCR calculation is done to determine how you qualify. Different lenders have different formulas for it. They basically take your net operating income and then divide it by your total debt service. And that gives them a number that helps them determine your qualification for the property. So that's also used in a lot of large multifamily deals where they're looking just at the income that property generates for the rental income in order to qualify and in the underwriting for the loan.